If you do get a question on pension accounting, it is very likely that you will be asked to calculate the total periodic pension cost. And you must remember this formula. The total periodic pension cost is equal to the change in net pension liability plus the employer contribution. And by now you must know that a change in something means the ending value minus the beginning value. So let's look at a simple example. We are given the present value of the defined benefit obligation at the end of 2014 and end of 2015. Similarly, we are given the fair value of plan assets at the start of 2015 and end of 2015. So these are end of year numbers. So 80 over here means beginning of 2015. And for your convenience, we are also giving you the net pension liability or the funded status. So at the end of 2014, we have a net pension liability of 20, and at the end of 2015, we have a net pension liability of 23. Here we are assuming that the employer contribution is 0. So the total periodic pension cost is the ending value 23 minus 20, which is equal to 3. So the total periodic pension cost is 3. Here is another scenario where we've not been given the funded status. So we need to calculate the pension obligation at the start of the year. So we are taking 2015 again. So at the start of 2015, the net pension liability is 10, and at the end of the year, the net pension liability is 5. The employer contribution in 2015 is 2. So we don't consider the employer contribution in the previous year. Certain benefits are paid, but in our calculation, we do not consider the benefits paid because these impact both the obligation as well as the plan assets. So just remember this expression. The change in net pension liability is the ending value, which is 5, minus the beginning value, which is 10, plus the employer contribution, which is 2. So here we'll have 5 minus 10, which is minus 5 plus 2, and this is equal to minus 3, which means that the cost is minus 3. A cost of minus 3 really means a pension income of 3. Here is a third scenario, and again we can use the same formula, which is change in net pension liability plus the employer contribution. So what is the pension liability at the start of the year? In this case, the fair value of plan assets is actually higher. So we have a net pension asset of 10. If we express this as a liability, that is going to be minus 10. What about at the end of the year? Again, the asset is more, so we have a net pension asset. In terms of liabilities, this can be minus 5. So we are going from minus 10 to minus 5. The change is the ending value, which is minus 5, minus the beginning value, which is minus 10, plus the employer contribution, which is 2. So we can do our basic mathematics here. Minus 5 minus minus 10, which is plus 10, and then plus 2. This gives us 7. So the total periodic pension cost is 7. Now, sometimes in the curriculum you'll see a different convention. If we take assets as positive and liabilities as negative, and we take any inflow or income as positive and expenses as negative, then the formula can become the pension income. So the total income is equal to the change in net pension asset minus the employer contribution. So over here, what is the change in net pension asset? We have an asset of 5 at the end of the year, minus we have an asset of 10 at the beginning of the year. So you have 5 minus 10 minus the contribution, which is 2. So 5 minus 10 minus 2 is minus 7. The pension income is minus 7, which means that the expense is 7. So these are just two different ways of looking at the same problem. I would prefer that you remember this formula, that the total pension cost is equal to the change in net pension liability plus the employer contribution. And I say this because generally most plans are underfunded, so we typically have a net pension liability at the start of the year and at the end of the year. Now let's look at this example. We have a company which follows IFRS, and we are given the different components of the periodic pension cost. We are also given a reconciliation between the pension obligation at the start of the year and the end of the year. Similarly, we have a reconciliation between the fair value of plan assets at the start of the year and the end of the year. First question is, what is the funded status at the start and end of the year? So the funded status is simply equal to the obligations minus the fair value of assets. So we have a present value of obligations equal to 30,000, assets are equal to 25,000, the liabilities are more. So at the start of the year we have a net pension liability equal to 5,000, and at the end of the year we have a net pension liability which is this number minus this number, which is 4650. So over the year the net pension liability actually comes down. Next question, what rate is used to calculate the net interest expense? Now you might recall from our IFRS discussion earlier that the net interest expense is equal to the net pension liability times the interest rate. In our case, the net interest expense is given, this is 250, and the convention we are using is that the expenses are shown as positive numbers and any income or gains are shown as negative numbers. So the net interest expense is 250. This is equal to the net pension liability at the start of the year times the interest rate. So the net pension liability at the start of the year is 5,000, that we calculated earlier. The interest rate is what we need to calculate. So the interest rate is 250 divided by 5,000, which is 0.05 or 5.0%. What does remeasurements include? Now again, recall from our earlier discussion that remeasurements has two components. One component is the actuarial gains and losses. The other component is the actual return on plan assets minus the plan assets into the interest rate. We are told that the actuarial gains here are 0, so there are no gains or losses. So in our somewhat theoretical example, this is 0, though in the real world this is seldom 0. The entire remeasurements then in our example is this component, and we are shown that number minus 150. A minus here means a gain. Since the service cost and net interest expense are shown as positive numbers, the remeasurements is a negative, which means that this is positive. So let me show you where this 150 number comes from. If we look at the plan assets or the change in plan assets, one of the items here is the actual return on plan assets. So this actual return number is 1,400. The plan assets at the start of the year were equal to 25,000. So you have 1,400 minus 25,000 into the interest rate, which is 5%. So when you do this calculation, you will get 150. This is a gain of 150. The actual return was higher than this number. So this is going to reduce the overall pension cost. And let's look at the numbers here. The service cost is 250, net interest expense is 250, so this is 500. This gain is going to reduce the pension cost, so we subtract 150 and we have 350. So 350 is our total pension cost. And the question was, what does remeasurements include? Remeasurements basically includes this number. Next, what is the actual rate of return on plan assets? Here we are asked for the rate, and this is very simple. We are told that in dollar terms, the return is 1,400. The initial value of plan assets was 25,000. So 1,400 divided by 25,000 is 5.6%. Next, which cost components are shown in P&L and which are shown in OCI? Now again, go back to our discussion on IFRS. Service cost is shown under the P&L. Net interest expense is also shown under P&L. So these two components are shown under the profit and loss statement. So in the P&L, our pension expense is going to be 500. Under remeasurements, we show minus 150, and on the previous slide I talked about where we come up with this number. So this is actually a gain in OCI. What is the total pension cost for 2015? So one way of coming up with this total cost is simply adding up the numbers, and that gives us 350. But I also want to show you the other method. As discussed earlier, the total pension cost for a period is equal to the change in net pension liability plus the employer contribution. The net pension liability at the end of the year is 4650. The net pension liability at the start of the year was 5,000. And then you add the employer contribution, which is shown over here. That contribution is 700. So add that, and what you will get is 350. So this is the total pension cost for the period. As I discussed earlier, you can use another method also. If we say that assets are positive, liabilities are negative, income positive, expenses negative, then the ending funded status is actually a negative number. So since we have a net pension liability, and if we are saying liabilities are negative, then we can say minus 4650 minus the beginning funded status, which again is negative because it's a liability, so minus 5,000, and then minus 700. So this is going to give minus 350, and in this convention an expense is negative, so minus 350 means an expense of 350. So either way we get the same answer. We will now look at an example which compares IFRS and US GAAP. Let's say that for a given company we have this data, and this is data for 2015. We are told that in this year the employer contributions were 3,000, current service costs 600, and so on. We are also given the pension obligation at the start of the year, at the end of the year, the plan assets at the start of the year, end of the year, and so on. The first question is, what are the retirement benefits paid during the year? And this number would be the same for both IFRS and US GAAP. Then we need to show the reconciliation between the benefit obligation at the start of the year and the benefit obligation at the end of the year. This is similar to something we saw in an earlier example. So what I want you to do is say that the pension obligation at the start of the year is this much. Then what are the various numbers that take us from here to here? Question 3 asks about the reconciliation with respect to plan assets. So how did we go from here to here? Then you are required to calculate the total periodic pension cost. Question 5 asks you to show the allocation of this total cost between P&L and OCI under IFRS, and then what is the allocation between P&L and OCI under US GAAP. With US GAAP, make the assumption that if any cost can be allocated to either P&L or OCI, then it is being allocated to OCI, and let us ignore any amortization of expenses from OCI into P&L. So try this before you move on. Now I'll help you with the first question, which is what was the benefit paid by the company during this year. To do this, you can either take a liability approach or an asset approach. So let's say that the beginning pension liability is shown right here. So that's this number, 176,400. Then what are the various items that will take you from here to the ending liability? You are going to add the current service costs, then the past service cost, then we have the interest cost. Now the interest cost is not explicitly given, but we do have the discount rate, which is 8%. We do have the pension obligation at the start of the year, so you can take 0.08 times this number, that's the interest cost. Then we have the benefits paid. So the benefit paid will actually reduce the liability. So you can say minus the benefit paid. And then we have an actuarial loss. An actuarial loss increases the liability. So we can add the actuarial loss. And when we do this maths, what we should end up with is the pension obligation at the end of the year, which is 175,560. Of all these numbers, the only one that we do not know is this benefit paid. We know the beginning liability, we know the current service cost, we know the past service costs. I just told you how to calculate the interest cost, which would be 8% into this number, and then minus some benefit paid plus the actuarial loss, which is this number, gives us this. So through algebra, we can calculate this number. And here I will show you the numbers. So we have this. The benefit paid is a plug because all other numbers are known. Now this is shown as a negative, which means that the benefit paid actually reduces the liability. So when you solve for this number, you get minus 17292. Another way of calculating the benefit paid is through the assets. Initially, the fair value of assets is this much. We are given the actual return, which is increasing the value of assets. The employer contribution number is shown, so that also increases the value of assets. The benefit paid reduces the value of plan assets, so that's why we have a minus. And then the fair value at the end of the year is given. So again, we could calculate this using algebra. All right, now you need to also answer these questions, and they should be straightforward. What's the funded status at the start of the year? What's the funded status at the end of the year? So for start of the year, you look at the pension obligation at the start of the year and the plan assets at the start. So clearly this is very underfunded. So we have a net pension liability, which is this minus this. At the end of the year, the net pension liability is this minus this. What is the total periodic cost? That is going to be the change in net pension liability plus the employer contribution, which is 3,000. Then the pension cost under P&L. So we need to remember which components are reported under P&L under IFRS. What is reported under P&L if this company were following US GAAP. then what is OCI under IFRS and OCI under US GAAP. And here we are assuming that if a company has a choice between categorizing a cost or an expense under P&L or OCI, here it is going to categorize under OCI. So let me show you the numbers. The funded status at the start of the year, as I said, is the difference between this and this, which is 59400. The funded status at the end of the year, you should get this number again, the difference between assets and liabilities at the end of the year, and these are both net pension liabilities. What is the total periodic cost? So that is the change. So it's going to be this number 64752 minus this plus 3000. So that's the total periodic pension cost for the year. Then what is the pension cost in P&L under IFRS? So remember, under IFRS we are going to have the entire service cost, and under IFRS we don't really distinguish between current and past. So we are going to have 600 and 360. We then have the net interest expense, which is equal to the discount rate of 8% times the net pension liability at the start of the year, which is 59,400. So we add all these together and we should get the pension cost under IFRS, which is 5712. Then the pension cost that is shown in the profit and loss if we were using US GAAP. With US GAAP, only the current service cost is shown in the P&L, so we have 600. Then we have the interest expense, which is going to be 8%, 0.08 multiplied by the pension obligation at the start of the year, which is 176,400. And from this we subtract the expected return on plan assets. So we are going to subtract 10%, which is 0.1 times the plan assets at the start of the year. The plan assets at the start of the year equal 117,000. This plus this minus this should give us 3012. So this is an expense. Notice that here the pension expense shown in the P&L is higher under IFRS than it is under US GAAP. Next, OCI under IFRS. So this has two components. One component is the actuarial loss. So the actuarial loss is 1380, and then from this we subtract the actual return minus 0.08 times the plan assets at the start of the year. So the actuarial loss is 1380 minus the actual return is 8100 minus 0.08 times the plan assets at the start of the year, 117,000. So when we do this calculation, we should get 2640. Pension cost in OCI under US GAAP. This is going to include the past service cost of 360. There is going to be the actuarial loss of 1380, and then we subtract the actual return, which is 8100, minus 10% of this number, 10% because the expected rate of return on plan assets is 10%. So minus 0.1 into 117,000. So this gives us 5340. So far we have talked about the allocation of pension costs between other comprehensive income and the profit and loss statement. Now we will look at the classification of pension costs which are recognized in the P&L. Pension costs are shown as operating expenses. However, the interest component and asset returns are non-operating. So we need to make an adjustment. The adjustment is that we should show service cost as an operating expense, and we should add the interest component to the company's interest expense, and we should also show the return on plan assets as a non-operating interest income. Let's consider a very simple example. We have a company which follows US GAAP, and it has this income statement. We also have a pension disclosure which says that the current service cost is 5. So the brackets means that it's a cost. The interest cost is 2. The expected return on plan assets is 6. But the actual return on plan assets is 8. So what sort of an adjustment do we need to make? And specifically, what is the profit before tax if the actual rather than the expected return on plan assets is used? So let's start doing this. The difference between 6 and 8 is 2. So very easily we can say that the actual return is 2 more, so the profit before tax needs to be 2 more, which is going to be 61. Now let's look at the specific or the individual line items. What is the operating expense if we do make these adjustments? Currently, these 3 items which are part of the profit and loss statement, so these collectively become the pension expense, and we have a pension expense of 7 and then a return of 6, so the overall pension expense is 1. And if we are using brackets for negative, the pension expense is -1. If we pull out the pension effect from the operating expenses, then the operating expenses will be -39. And then we say that the only expense that we want here as an operating expense is the service cost. So that service cost is 5. Then the operating expense will become -44. So we have pulled out the interest cost and we pulled out the expected return on plan assets. The only thing that we are left with is the current service cost. The EBIT then becomes 56. Now what about the interest expense? The interest expense was 2. We pulled that out of operating expenses, but that interest expense now needs to be added over here. So the interest expense now becomes 12. The interest income needs to be adjusted. Originally it was 9, and then we add 8 because the actual return on plan assets is 8. So the adjusted interest income is 17. Now if we add these numbers, so we have EBIT of 56, take out the interest expense, add the interest income, we end up with a profit before tax of 61. Now work through example 5 in the curriculum. Next we deal with adjustments related to cash flows. Here are the 2 key points. If a firm's contribution exceeds the economic pension expense, this is a form of repayment. On the other hand, if a firm's contribution is less than the economic pension expense, this is a form of borrowing. Here I use the term economic pension expense. This is the same as saying total pension cost, which includes both the P&L component and the OCI component. Let's take a very simple example. Say we have a total pension cost during a given period of 100, and the company contribution during this period is 120. The tax rate is 25%. Normally, a contribution by the company is shown under cash flow from operations. However, if we have a pension cost of 100, a total pension cost of 100, and the company is making a contribution of 120, the extra 20 is reducing the pension liability. So since the pension liability is being reduced, the 20 should really be categorized under cash flow from financing. So 100 should go to CFO and 20 should go to CFF. These numbers are on a before tax basis. If we have a tax rate of 25%, then on an after tax basis, we'll have 20 times 1 minus 0.25, which is 20 into 75%, 15. So on an after tax basis, the adjustment needs to be 15. So this 15 before adjustment was shown as an outflow in the CFO segment, but it needs to be moved to the CFF segment. If before the adjustment the inflow was 300 and then this 15, which is a minus or an outflow, if this is being removed from CFO, the CFO is actually going to go up. So from plus 300 we go to plus 315. The CFF before adjustment was an outflow, so it was minus 200, and since this 15 is going out now and it needs to be categorized under CFF, we subtract 15 and we end up with minus 215. So after adjustment we should show an outflow of 215. Now I want you to work through example 6. We now come to section 3, which is share-based compensation. Share-based compensation is intended to align incentives of management and owners. Share-based compensation must be treated as an expense even though cash does not change hands. This expense should be measured at fair value. So if employees are getting stock options, then the value of those stock options should be based on fair value, and that is what needs to be shown as an expense. As an analyst, you should look at the disclosures. There you will see the nature and extent of the share-based compensation, and then an analyst can evaluate the impact on financial statements. There are some disadvantages of share-based compensation. One is that employees may have limited influence over the market value of a company. Now, the CEO and the CFO, for example, might be getting options with the idea that their incentives will be aligned with shareholders. But if the ability of the CEO and CFO to influence the market value of the company is limited, then those options are not really helping. The second point is that incentives such as stock options might make managers more risk averse or less risk averse than they should be. This might seem contradictory, but let's understand this through an example. Let us say that employees get stock options with an exercise price of 25, and let's say that the current company stock price is 20. For the employees to make money on the stock options, the value of the stock must go up above 25. If that happens, then the employees benefit. On the other hand, if the stock goes down, then there is nothing to lose. So, given that options have a one-sided payoff, there is an incentive to take extra risk so that these options are in the money. On the other hand, if the stock price is much higher than the exercise price, so we might have an exercise price of 25 and the stock might now be up at 40. In this case, the management which has stock options might play it extra safe so as to lock in this gain. So with stock options, either of these issues might exist. Either the managers might be more risk averse than necessary, or they might be less risk averse than they should be. And the final obvious point is dilution. When management is getting shares, the number of shares outstanding goes up, so EPS comes down and also the ownership gets diluted. Now, the three broad categories of share-based compensation are shown right here. The first category is stock grants, and here we have three subcategories. The most basic is an outright grant where employees get shares. This expense needs to be reported at fair value. So this is the fair value of the stock on grant date, and let's say that the service period is 4 years, then the expense needs to be allocated over the 4 years. Another category is restricted grants. Here, shares have to be returned if certain conditions are not met. The expense should be reported on the fair value of the stock on grant date, and the compensation expense is allocated over the service period. So these 2 points are common. Performance shares. Here the compensation is determined by some performance measure other than share price. And as before, the expense is reported on the fair value of the stock on grant date, and compensation expense is allocated over the service period. Next we come to stock options, and I'd say this is the most testable segment. Stock options need to be reported at fair value. Accounting rules require the valuation of options using models. Now, the options that employees get might not be traded in the market, and if there is no fair market value available, then we use models such as the Black-Scholes model or the binomial model to come up with the value of options. This is something you will see in detail when you do derivatives, but at a very basic level, there are several variables that impact option prices, and those variables are shown here. Since we are generally dealing with call options, so here's how you can think of this. We have an option pricing model, and these are the various inputs to the model. The model will give us an option price. Of these inputs, the only one that is completely objective is the exercise price. So an employee might get options with a strike price of 25. So there is no ambiguity here. But with these other variables, there is some subjectivity. So in coming up with the option price, we need to assume a share price volatility. The higher the volatility that we assume, the higher the value of the call option. So if a company wants to show a high expense, it can increase this assumed volatility. If a company wants to show a low stock option expense, then it can assume a relatively low volatility. The estimated dividend yield on the stock is another subjective variable. The higher this estimated dividend yield, the lower the value of the call option. The risk-free rate also has an impact on the call option price, though this is not a very strong relationship. If the risk-free rate is higher, the call option is a little bit higher. This is the call option price. Estimated life of the option. So the longer the life, the higher the value of the call option. So at this stage, just remember these relationships. You will understand them better when you do derivatives. From an exam point of view, you might see something like this, that in 2014, a company assumed a volatility of 15%, and then in 2015, if the assumed volatility goes up from 15% to 17%, then what will happen to the estimated option price? And the answer here would be that if this volatility number is going up, that means that the option price is going up. In other words, the expense is going to be higher. When a company grants stock options, there are several important dates. One is the grant date. This obviously is the date when the options are being granted. The vesting date, this is the date when employees can first exercise the stock options. So if an employee is told that he can exercise the stock options after 4 years, then 4 years is the vesting period, and the date 4 years later would be the vesting date. After the vesting date, the employee can then exercise the options. The compensation expense is allocated over the service period. So if the value of options being given, let's say, is 100 million, and those options are based on a service period of 4 years, then we allocate this expense equally over the 4 years. Here is an example of what we are talking about. A company awards 1 million stock options to its executives on 1st July 2015. The estimated cost of each option is 0.5. The options require a service period of 4 years after the grant date and before vesting. what is the stock option expense for 2015? So do this before looking at the answer. Here is what you should get. We have 1,000,000 options times 0.5. Here the fair value of the options is given. And then we divide by 4 because the service period is 4 years. So every year the amount would be 0.5 million divided by 4. And then since these options are being granted in the middle of 2015 and we want the allocation for the second half of 2015, we multiply by half. So the expense for the year 2015 is going to be 62500. As mentioned before, both stock grants and stock options have the potential to dilute earnings per share. So some companies work with stock appreciation rights or SARs. Here, companies compensate employees based on an increase in share price. So actual shares or options are not given, but compensation is tied to the change in share price. There are two advantages of doing this. One is that potential risk aversion is limited. The second is that shareholder ownership is not diluted. SARs are valued at fair value and allocated over the service period. This statement is extremely important. You see it over and over. And a disadvantage of SARs is that they require a current period cash outflow. This brings us to the end of the reading. Here is a summary of the main points. You should know the different types of post-employment benefits. The most testable or the most significant part of this reading is the pension obligation and the pension cost. So the pension obligation is the present value of future obligations. You need to understand the different pension cost components and how to calculate them. You need to understand the impact of assumptions on pension obligation and cost. You need to know how to make adjustments. So with the pension cost, typically it's all shown as an operating expense, but there are components of the pension expense which are non-operating. So you need to know how to make those adjustments. You need to know how to make the cash flow adjustments. And you also need to know the impact of assumptions on share-based compensation, specifically with stock options. As always, I want you to read the summary, review the learning objectives, do all the examples in this reading, do all the practice problems, and also do practice questions from other sources.